They say the economy is strong. So why does your grocery cart feel too expensive to fill? You're standing in the aisle, cart half full. The total already feels too high. The news says the economy is strong because people keep spending. That sounds comforting. But history says the warning isn't the spending. It's where the money is coming from. To see why, rewind to the 1920s. In April 2026, new government data showed Americans kept spending, but the saving rate fell to 2.6%, households saving only a thin slice of what's left after taxes. Inflation was still squeezing budgets. And the war with Iran pushed gas prices up, roughly $1 more a gallon, straight into those same budgets. So the question is simple. If people feel broke, why does spending keep rising? The 1920s had an answer. In the 1920s, the American economy looked modern, fast, and confident. Cars, radios, furniture, and appliances were filling homes. But many families were not paying all at once. They were using installment credit. That means you buy now, then pay a little at a time. It made expensive things feel reachable. It also made the economy look stronger. Stores were selling, factories were producing. But credit can act like a second paycheck. It helps spending continue after income starts feeling too small. And 1920s had another layer. Investors were borrowing money to buy stocks. That was called margin debt. So the same pattern showed up in two places. Households borrowed to keep buying, investors borrowed to keep betting. Everything looked fine until confidence had to do the work that income could not. That is when the first hairline fracture appears. The crack does not always start with people buying less. Sometimes it starts when people run out of room. A grocery bill rises, a card balance rolls over, a car payment stays due, gas gets more expensive. That is the dark part of consumer spending. Strong sales can hide weak households. In the 1920s, the boom kept glowing until debt, speculation, and overconfidence met a sudden loss of trust. When the stock market broke in 1929, the weakness that had been hidden underneath became impossible to ignore. Today is not the 1920s. The banking system is different, the economy is larger, the rules are different. But the pressure has a familiar shape. Higher income households can keep spending on travel, restaurants, and services. That can make the national numbers look healthy. But lower and middle income households may be using credit cards, smaller savings, or delayed choices just to keep up with groceries, rent, gas, and bills. That is a K-shaped economy. One group climbs, another group stretches. The average number hides both lives. The lesson from the 1920s is not that every spending boom becomes a crash. That would be too easy. The lesson is sharper. Spending alone does not prove strength. Sometimes it proves pressure. So when the economy looks strong, ask the older question. Are people spending because they feel confident, or because they have no choice?